Welcome everyone. Welcome to our webinar, Cottage Succession Planning. We have lots of details tonight. We're going to go through ways to minimize the tax, ways to efficiently pass it to the next generation. So we're going to cover all of that tonight. A reminder, we've done other webinars in the past as well, and you can always check those out on our YouTube page. So please feel free to do that. But tonight, all about cottage succession. Kevin and I will spend a couple of minutes up front introducing our team, and then we're going to hand things over to Adam Buss, our wealth and estate planning specialist, and he'll go through all the different tips and tricks and ways to efficiently pass the cottage along to the next generation. So we'll cover all those details, but before we do that, Kevin, let's do a quick overview of the firm involved.
So basically what we are, Clinton and myself are part of Canaccord Genuity Wealth Management. We are the largest independent investment firm in Canada. We manage roughly $73 billion in assets around our globe that we deal with. Offices across Canada from coast to coast as well. We are in Australia, the UK, as well as the US. And finally, another point that we should mention is that we are a member of the CIPF, or the Canadian Investors Protection Fund, which is the same security backing that the big banks use going forward. So we have it all encompassed in one area, and this is who we are in Canaccord Genuity.
Absolutely. And I will mention our goal tonight is to ensure everyone leaves with some information they find of value. And a great way to do that is by participating. So feel free to ask questions, whether you're watching on Facebook or you're watching on YouTube. Simply type into the comment box. We can see those, and we'll try our best to answer as many as we can. What you see on the screen, our smiling faces there, that's our team, the Becker Wealth Management team. Our promise to each and every client, it is commitment, clarity, and confidence. For us, commitment, that's all about communication. Clients need to hear from us. Things change in the financial world. We want to make sure we're on top of it, and we do our job there. It should lead to clarity. Clarity in the goals, clarity in the objectives, when all the cards on the table when it comes to fees, rates of return, high level of commitment, high level of clarity, the end result, confidence. Confidence in our team. Most importantly, we want folks to have some peace of mind and confidence with their financial plan. And when it comes to the financial plan, we do use a process. I like to call it financial architecture. I won't go through all the details tonight, but the idea is we cover all the different pieces of that financial plan. We're zooming in tonight specifically on cottage succession, but a reminder, we can help out in all the other areas of that financial plan. So I think with that, Kevin, we're going to bring on Adam Buss, right?
Yes, Adam Buss is a member of our wealth and estate management team. He deals with the financial planning process, so all the goals and environment that goes along with that one, including, as our topic is tonight, cottage succession planning. And without any further ado, I will leave this over to Adam Buss. Adam, take us away.
Excellent. Thanks, Kevin. Thanks, Clinton. Always great to be here. Certainly excited to talk about this topic. We're going to cover a lot of great information for you this evening. First of all, I do want to start off as a financial planner. I'm not an accountant. I'm not a lawyer. Certainly, this entire presentation is not to replace the advice that they provide to you. Certainly want to cooperate and join forces with your accounting team, your legal advisor, to make sure that we're getting the right advice to you, and especially when it comes to cottage succession planning. So we're going to cover a lot of information today, certainly not necessarily direct advice for your particular unique circumstances. We'll do our best to kind of cover as much variety of topics as we can, different scenarios, different strategies, different information to consider. But of course, discuss this with your advisor, discuss it with your lawyer, your accountant, your family, to make sure that we got the right strategy in mind for your situation. A little bit about myself, the part of the process. So we do meet with clients. So my job as the financial planner on the team is to meet with clients. I want to help you achieve what your financial goals are. And for those who do have secondary properties, vacation homes, cottages, that forms a very important part of the wealth plan. It's how do we transition the cottage to the next generation? What's the best way to do it? How do we minimize tax on it? Those are all different things that come up in the conversation that we want to come up with a well-rounded plan to help our clients address. Now, throughout the plan, the conversation today, we won't cover, U.S. vacation properties. We're looking at primarily it's Canadian-based vacation properties, cottages, second homes, those types of things that a lot of this information would apply to. So just a bit of an overview kind of on our how we look at the financial planning, how it's done here at Canaccord. So certainly want to make it sure we're looking at the entire full holistic picture to make sure that we're giving our clients the right advice. Now, when we look at cottage succession planning, as that's what we're here today for, it's actually kind of a good coincidence. I believe the border to Manitoba, Ontario is opening up today, so kind of a timely topic now that a lot of Manitobans can go back to Kenora, Lake of the Woods, and enjoy that family cottage time. So why is the family cottage so important? Well, for many families, it does bind the family. It's a gathering place for the entire family to get together. I mean, we are so fortunate in Canada to have such incredible parks, lakes for us to enjoy. A lot of family cottages have been in the family for quite a long time. You know, there's a lot of memories that are there that are important, that, you know, are tied to that particular property that they want to keep in the family. You know, we value our leisure time, we value our outdoor activities. There can be quite a strong emotional attachment when it comes to that family cottage. So whether it's the parents, the kids, the grandparents, you know, again, it's the gathering place, and of course, it can be an incredibly valuable asset. For those who have cottages or have been either shopping around for cottages, have probably seen the prices kind of skyrocket over the last years, and you know that's constantly going up in value, hopefully. When it comes to planning, especially when it comes to, you know, an emotional asset such as the cottage, you know, it's very important to have an open, honest family discussion as to, you know, is everybody on the same page? What are the wishes? What are the vision for this property? We want to make sure that the whole family's on board. You know, are there multiple children? Who's going to inherit the cottage? Will they share the cottage? You know, big one is, do they actually want the cottage? You know, who wants the cottage? Sometimes the obvious choice isn't actually the one that actually wants the cottage in the end. Perhaps, you know, kids only wanted the cottage because it was, you know, they enjoy the time going to spend with their parents at the cottage. And if their parents are no longer around, maybe that cottage isn't as important. Maybe they already have their cottage and they don't want to have a secondary cottage. Perhaps they moved out of the province and they're not willing to travel back to the province to actually be at that cottage, or they don't have the time to dedicate to it. Is fair the same as equal? This is a huge thing. You know, if one child gets a cottage worth $500,000 and there's a second child or a third child, does that mean each child should get $500,000 as well? Is that fair? Is that equal? Fair, again, does not necessarily mean each child needs to get $500,000. Maybe it's something else that's of sentimental value. Do you require the funds or want the funds for your retirement? You know, as we did state, I mean, it can be quite a valuable asset. You know, maybe it is $500,000, $1 million that's sitting in this property value. Maybe you're relying on those funds, hopefully, to fund your retirement time. Well, if you just gift the cottage down the road, how are you going to get that money to live off of to subsidize your retirement? Maybe that's the case, maybe that's not the case, but certainly a factor that we want to build in. Will the property cause any financial hardships, or are there family dynamics to be considered? Certainly, there can be a lot of family dynamics that can be involved when it comes to money, when it comes to assets, when it comes to the emotional side of, you know, parents passing away. So very important stuff to consider. Also want to ensure, of course, your wishes and the plan are properly documented in your will. You can have the absolute best of intentions. If it's not properly documented, properly laid out, it might not happen actually according to your wishes. So we certainly want to make sure there is an alignment of how those things should happen. So what's been happening in the cottage market? You know, for those who have been in Winnipeg, obviously the real estate market's been a little hot over the last year or two. So, you know, that does also apply to the cottage country. So I looked up some stats and how have cottage values grown over the last 2 years. So these, you know, if you're watching outside of Manitoba, these are probably the two more popular spots in Manitoba that people may have cottages. So we have the Interlake, we have Lake of the Woods. You know, it's been a phenomenal growth in value. Some people look at me like I'm crazy, just growing a property value at inflation rate. As you can see, we've had some leaps and bounds in growth, which of course, you know, can lead to a very large tax situation down the road. So The numbers may be a little bit surprising, but we certainly have experienced a large amount of growth in that cottage market. I do see that Kevin's come back to join me.
Yeah, I do have a question for you going forward. With some of the probate laws that have just changed in Manitoba recently, and we were mentioning Manitoba and Ontario here, but we also have people watching down on the coast in BC, Alberta, Saskatchewan, across the country. Is probate something that I should consider or consider avoiding based on what's going on from province to province? Is this going to have a large impact on my cottage succession planning?
Yeah, that's a good question, Kevin. So every province does set their own probate fees. So even though as of last year, Manitoba decided to waive probate costs going forward until, of course, they decide to change their mind on that one. But for right now, there is no probate cost in Manitoba. However, if you're a Manitoban and your cottage is in Kenora, that Kenora property is subject to Ontario probate fees. So even though in Manitoba we think, we're fine, we don't have probate, Ontario, I believe, is 1.5% of probate fees. It's one of the higher provinces. So that is something to be aware of. Each province does set their own rules when it comes to that and has their own probate costs. So certainly want to be aware of whichever jurisdiction you're living in and the property happens to be located in. Thanks, Kevin. Good question. So we do say all this growth, of course, leads to a tax time bomb. Maybe it's hard to see on the screen. The one line is projecting where the property value is going just at an approximate inflation rate over the years. And of course, there's another line projecting the tax bill that's associated with the cottage. So of course, naturally, cottage value goes up. The tax bill that's going to go along with it also goes up. So certainly something to be aware of, even though, maybe you just bought the cottage today, not much of a tax problem yet. Likely there might be a tax problem down the road that we need to be aware of, which is often where people come to me saying, how can we get around this tax situation? What's the best strategy to deal with it? So we do have some different ideas coming up that we can talk about on that one. So what's happened in the past? So I don't want to go down a lengthy rabbit hole of all the different tax situations that happened in the past. These are a few things that you might have heard of, might have come across. Again, it really depends how long that you've either owned that cottage or that cottage has been in the family. Some of these things may have happened along the way. There's valuation date. There's no capital gains prior to December 31st, 1971. So it was less of a problem back then. Prior to 1982, members of a couple could have two different principal residences, so there was an additional exemption there. There was a one-time capital gains exemption that you could do roughly in 1992, so that's another time you could boost the cost base of the property, which we'll chat about cost base coming up. And of course, did you already inherit the cottage? Maybe your parents inherited the cottage from your grandparents. At what value did they inherit that property? Because that helps set what their cost base is when they pass away or when they transition the cottage to the next generation. So a lot of these things are important to know. And I always say it's good to, keep these things in the file. If your kids have to find all this information after you passed away, they're going to be scrambling and trying to find mom and dad's, tax returns and historical information. It can be an absolute nightmare, and might not get all the tax savings that you are entitled to. New reporting requirements on properties on tax. I shouldn't say really new. It's been around since 2016, but in the past, you weren't actually required to disclose to the CRA on your tax return if you sold a property. As of 2016, it's now mandatory that if you sell a property, it doesn't matter if it's a principal residence, if it's a rental property, if it's farmland, if it's regular land, cottage, you have to say, what you sold it for, what the cost base was, when you bought it, how many years it was your principal residence, full disclosure to the CRA to make sure that happens. Clinton.
Yes. And jumping in with a quick question here, Adam, you mentioned that change in 2016, so perhaps not everyone's aware of it. What would happen if you sold a property but you didn't go through that disclosure process?
Well, it's usually never good things if you don't disclose things to the CRA. They have a way of finding these things out and getting what they're owed or having additional fines, penalties, interest charges for failure to disclose these things, which generally are not so much fun to deal with. So certainly if you are selling a property, have a chat with your tax professional. I'm sure they're going to ask you for some additional information so that they could fill in the required boxes on your tax return to make sure that's completed and CRA is happy with you moving forward.
Excellent. Thanks, Adam.
Thanks, Clinton. And don't forget to submit any questions on the chat. Clinton and Kevin will be monitoring that throughout. So a lot of this does come down to, what is the cottage tax bill going to be? So a lot of that is based off what is your adjusted cost base. So as we always call it, your ACB. So that is, cost of acquisition. So what did you pay for the property originally, or what did you inherit the property at? And what qualifying renovations took place? Have you renovated the property since you bought it? What expenses actually increase your adjusted cost base for tax purposes? Because not everything you spend money on is going to increase your ACB for tax purposes. The higher the ACB versus the sale price, hopefully the lower your capital gains is going to be when you go to sell it for tax purposes. So again, what qualifies as an actual capital improvement versus just regular old maintenance on the property? So kind of two different definitions. So there's a current expense. So that's generally considered maintenance. So it's defined by an expense that generally reoccurs after a short time period. So these might not be an all-inclusive list, but certainly changing a light bulb, even though it's a minor cost, we can't include that one. Staining the deck, you're going to have to do that every now and again, so you can't really include that. Repainting the walls, those types of things generally fall under maintenance. As for a capital expense, that's actually an improvement, improving the property's value. It gives a lasting benefit or advantage. New siding, great example. New deck. So instead of just staining the old deck, we're putting in a new deck. That can be a capital expense. Building a new dock, adding additional square footage, building a new garage, all those kinds of things are increasing the value, giving a lasting benefit. Definitely want to keep all your receipts anyways. Keep it in a separate file, ideally one file for each property. Even want to track them on your principal residence if you can, especially if you have two properties. That might come in handy when we're determining, maybe in a couple slides from now, which property to use as your principal residence when you go to sell it. Definitely want to discuss the expenses with your tax professional to determine what would be considered qualified. When in doubt, check with a CRA, look at the website, check with your tax professional, your lawyer. They can certainly help discuss what expenses might be considered as a capital improvement to increase the ACB. But again, keep all the receipts, definitely keep them in a file. Again, we don't want your kids scrambling, trying to figure out what mom and dad paid and when, and we do need to have this proof ideally on hand for CRA to justify what the adjusted cost base is on the property. So principal residence exemption, how does it work? So there's no capital gain when you sell your principal residence. This is in Canada, usually limited to the building, so the house, plus the first half hectare of land. It is a formula to determine how much of the property is completely tax exempt. So it's total years of ownership divided by total years that you've owned it as your principal residence. Plus you get to add another year for fun, as there can be sometimes an additional carryover that you do have two different properties for. Of course, you can only designate one principal residence at a time. So it's really simple. If all you have is one house, it's very likely your principal residence, which means when you sell it, you shouldn't have to worry about the tax consequences. When you do have two different properties, that's when you need to determine which one am I considering my principal residence when I sell it. And it is, again, when you sell it, that's when you have to decide which one is your principal residence. Could be your cottage, could be your, I'll call it city home for sake of argument, or non-cottage property. Clinton.
Great. Yeah, well, I wanted to jump in here. I got a couple of questions coming through. This one, I know you're on principal residence exemption, actually relates to your prior topic when you're talking about expenses and which ones are allowed to be part of your adjusted cost base. The question, they're asking specifically, well, a couple of them are asking about the roof, and I imagine it'd be depending on what you do with the roof. And then the second part of the question is the difference between, say, painting versus new siding. Would you be able to add some color to that?
You're talking about painting and adding color. That's a good one, Clinton. When it comes to the roof, again, I don't want to say which ones are specifically exempt. That really should be, with your tax professional. I've heard, if you're just swapping shingles, that can be justified as maintenance. If you have to maybe change the entire roof, I'm not a roofer. I can't describe what the process would be, but that might be, justified as a capital expense at that point in time. Painting the siding, that again is probably just going to count as a maintenance cost, especially if it's siding that has to be kind of refurbished every couple of years, get a fresh coat on there. That I would say is maintenance. But again, discuss these with your tax professional. And when in doubt, keep the receipts and have the accountant sort it out for you. Apologize to all the accountants on the line, but I've just created some more work for you.
That works. And keep the comments coming. Keep typing them in there. We'll get to as many of those questions as we can. Thanks, Adam.
Excellent. Thank you. So the next one is, we do talk about which property should be considered your principal residence. So again, we're using the city home versus cottage example just to make it clear as to which one might be a principal residence for you. So the city home, let's say an example, you bought it in 2005, so you've owned it, let's say 16 years. You paid $150, or at least that's your cost base. Fair market value $350,000. It's gained $200,000 in value. Meanwhile, the cottage you bought in 2011, adjusted cost base $250, fair market value $550. It's gained $300,000 in value. Moving there full time as of 2021. So the plan going forward is we're probably going to sell the Winnipeg home. We're assuming Winnipeg, and move to the cottage full time, probably for retirement time, or because we can do everything by Zoom these days. So which one of these makes the most sense to designate as your principal residence? So let's look at some of the fine details. So again, the city home, if we acquired it before the cottage, so it's automatically going to be 6 years as your principal residence plus 1 extra year, the lap, that's 7 years. So 7 divided by 16 total years owned is 43.75%. So 43.75% of the capital gain can be sheltered under the principal residence exemption. So if we look at it and try to figure out what is the actual capital gain that we have to pay tax on, based on the math, it's about $56,000 in change as the taxable capital gain. And then all of that $300,000 that's on the cottage is exempt. We are saying that the cottage was our principal residence since 2011. So I'm just going to go back one slide here. So again, here, bought the cottage in 2011. It's already gained $300,000 in value. Because of that dramatic gain, it might make sense in this scenario to say the cottage has been our principal residence since 2011. And then in the years prior to 2011, the city home was the principal residence. And again, this is declared at the time when you actually sell the property. So when you sell the city home in this case, it would likely make sense to declare the cottage. So again, want to keep the receipts for both properties. It helps with determining which might be the best selection. So in this case, again, all the taxable gain on the cottage is completely sheltered by the principal residence exemption for all the years owned. So that would be the likely best scenario. So if we look at a quick example of figuring out what is the cottage tax bill for, let's say, Joe and Mary have a family cottage at Falcon Lake. Joe and Mary, I think, are quite popular with this video series. Everybody that I usually pick on. Adjusted cost base of the property, $100,000. So this couple, they paid $75,000 for it, and they did $25,000 of eligible capital improvements. It's currently worth $500,000. So it's a $400,000 gain. If we factored the tax payable on that, would be just over $100,000. That's based on Manitoba tax rates. Again, if we project this out and say when they're 90 years old, what would be the tax bill? So it's grown to just over $1 million. It has a tax bill of about $239,000 now. So what are different ways that we can reduce the tax for this couple going forward? Well, what happens on death? What happens if you do nothing? Either you can do a separate bequest through your will. You can form part of your general estate. You can be liquidated to pay the tax bill. Perhaps the children are going to dispute over who gets to own it. What are the shared responsibilities? Maybe the children have to take a mortgage on the property when they inherit it. So we got to go and borrow $240,000 just to pay CRA. And now we get this cottage where we have additional expenses on, plus we're stuck paying, $1,000 a month on a mortgage. Is there cash to pay the taxes or to equalize the estate? So we gave the cottage to child number 1 and child number 2. They get the tax bill as part of the estate. And what else do they get? Do they get an equivalent $1 million? Is there $1 million of cash that you had sitting aside in an investment account? Now only $760,000 because we had to take $240,000 of that cash to pay the tax bill for child 1. These are different things that we want to consider. There's no one size fits all approach. Everybody's estate's going to be different. Everybody has different goals, different assets at their disposal, but certainly things that we do want to think of and take into consideration. Of course, that does come down to proper estate planning. We're going to make it a priority. Nobody loves to talk about death. We all want to make sure that our estate happens according to our wishes and try to minimize the potential disputes, landmines, problems that could come as a result. So I get questions all the time from clients, prospects. What are different ways that we can help, transition the cottage? What are some different scenarios? What are the pros, cons of some of these? And how might it fit for my particular situation? So probably the most popular one I get is, should I add my child to my title of the cottage now? What if my corporation owns the cottage? How does that work? Can I sell it to my kids at a discount, or can I just, gift it to them? What if I keep it and it's distributed through my will? What happens then? What are other options, and how do I avoid paying tax? So let's look through some of these and address some of the pros, cons, the pitfalls, and play them out. So of course, the popular one is as a spousal rollover. So those who are married, common law in Canada, can take advantage of a spousal rollover. So if you own the property with your spouse, your partner, right of survivorship, as soon as spouse number 1 passes away, it rolls over without any taxes owed to spouse number 2 until the second person passes away. Then it is considered sold or deemed disposed for tax purposes, and any capital gains that have yet to be paid are due at that point in time. So that helps defer it a little while, but again, it's only to the passing of the second spouse. Joint with right of survivorship, gifted equity. So again, I'll just add my child to my title. It's all good. That avoids the tax man, helps just transition the property to the next owner. So when a property is registered with joint right of survivorship, you're adding a second owner to the property. So technically you are disposing of a partial interest in that property. Your child immediately takes over ownership after the death of the co-owner. So we'll just use dad as an example. Dad adds, daughter to the cottage. Dad passes away. Daughter automatically inherits that cottage to her name. It's deemed disposed at time of title change. So dad adds daughter to the title. He is now technically selling it, even though no money's maybe changing hands. It is considered partially sold or fully sold for tax purposes. So it would also trigger taxation at that point in time. Do you have the cash on hand? If it was that $1 million example and the tax bill is $240,000, even though nothing's being sold, there's nothing being liquidated, do you have $240,000 kicking around in the investment account that you're willing to spend today to pay the government that tax bill? It should, in theory, avoid probate if it is right of survivorship. It does not mean it stays out of the estate and the additional complexities that can happen as a result of that. Taxation may be based on proportional ownership transferred with the remainder at death. This would be a good talking point with your accountant or your lawyer. Sometimes they will say, dad's transferring 100% interest of the property, but staying on title. Sometimes he's technically only transferring 50% ownership to the daughter, even though it's with right of survivorship, and then the rest would be taxed, the other 50% when he passes away. So those are good conversation points to have with both your accountant and your lawyer to make sure that those are all covered. So what are some pitfalls that can result from this? Well, obviously the big one is immediate exposure to taxation. So instead of just having this asset grow in value and pushing that tax back for as long as possible, dad adds daughter to the title. Okay, tax bill is owed right now. Exposure of the asset to the joint owner's creditors or potential marriage breakdown. You know, if the daughter is having financial troubles in her business, now she owns this asset, maybe it's not protected from her creditors who might go after her and sue her. This is an asset they would have access to. Potential marriage breakdown, again, is this considered marital property? Is it considered family property? That would be an area to chat with your lawyer about, just to make sure that that is protected in case that is of concern. Are there multiple children? You know, dad may be adding daughter to the title, but maybe he's got 2 other kids. You know, is this a presumption of resulting trust? So that is, did dad truly intend for daughter to take over ownership of the title and that it would be for her to benefit solely from after he passed away? Or was the daughter just merely holding on to it for the estate to be split with the other 2 kids as well? So that is something that has to be extremely well documented. So again, a good conversation point. If it's one child, it obviously can be a lot easier than if there's multiple potential beneficiaries to consider on the estate side. Loss of control. So as soon as dad signs the paper, daughter signs the paper, dad doesn't have full say as to what happens in that cottage. You know, potential loss of principal residence exemption. So maybe it's dad's principal residence now, but daughter has still a city home. You know, he can't claim the full principal residence exemption against his property because he's now added somebody to the title who is not necessarily the principal residence. Who's paying the expenses? This is a big one. You know, is dad covering all the expenses? Is daughter covering all the expenses? You know, again, if we go to that presumption of resulting trust, if dad is paying all the cottage expenses, is all the property taxes, maintenance fees, everything, is that considered a gift to daughter? Is that considered part of her future inheritance? Does that come off of her estate that she would get down the road when dad passes away? These are all different considerations that we want to make and things that do have to be very well documented when it comes to this. Kevin.
Yes, we had a question come in, basically something along the lines of, now, can this joint with right of survivorship work if it's principal residence, but not my kids?
I'm not sure I understand that one. Kevin, can you say it again?
Yeah, so if it's joint with right of survivorship, if it's principal residence, but it's not my kids that are dealing with it, is that something that we can deal with on this sort of scenario?
Well, I mean, for most part, most people have joint with right of survivorship on their principal residence with their spouse or partner. So, I mean, that is pretty easy. Also, usually not much of a big tax bill problem, but a lot of these different rules can apply, right? You know, if I add, daughter to my principal residence on the title, again, am I going to lose principal residence exemption? Even though it's maybe not a tax liability that results, a lot of these other risks that go along with it that are non-tax, especially when it comes to the estate side, are still a factor.
Wonderful. Thanks.
So hopefully that answered the question. If not, then just resubmit it to Kevin and we'll make sure we get it addressed for you. All right. So another way of transferring partial ownership in the title, I want to add my child to the property, would be something called tenants in common. So this is registering an interest in the property. So instead of saying I'm just going to add it and my child can take over ownership when I pass away, this is making a defined percentage to another owner. So parent might say I'm retaining 50% interest in my cottage. Adding child as 50% interest owner. So you're actually saying it is specifically 50% or 5 or 10 or 30, whatever percentage you want to allocate. Parents retain the 50% is taxed at time of death and is passed through their estate. So it does not automatically flow to the survivor on the title. It goes through the estate and happens according to how it's documented in your will. So 50% is transferred to the child immediately. When you do this transfer, it's considered taxable disposition. And of course, it's fairly easy to define that it's 50% of the gain at that point in time is taxed, and the other 50% is pushed outward. Very similar pitfalls, common issues that you'd have, very similar to the joint with right of survivorship. And again, this can kind of happen on any particular type of title. Tenants in common can fit for a variety of situations. I do often see it with second marriages or second relationships, where maybe both partners put in equal amounts to the property, and each of them might have differing estate goals to make sure their half of the property goes to their kids instead of just right of survivorship. So again, discuss that with your legal advisor as to how it might fit best for your situation. Big one is selling at a discount. So what if I just sell my cottage to my children or my child for less than it's worth? Well, I mean, at the end of the day, it doesn't matter too much what you decide to charge your child for the cottage. It does make a big difference for CRA. The sale price does not determine what amount you must pay tax on when it's a non-arm's length transaction. So if Kevin was to sell his cottage to me, I'm not related to him. CRA really doesn't care what he sold it to me for. He's going to pay tax on based on the sale price. If Kevin sells the cottage to his son, it does make a difference. They care what the value of the cottage is, not the sale price. Okay, so that is a huge difference. So the cottage, I'll use quick round numbers. I might even have an example coming up here. Okay, I'll use the round numbers on the next page. But it does make a difference as to the cost base. So if I sell the cottage to my child for $1, the dollar is their cost base going forward. And then that can lead to double taxation. So as I'm taxed based on fair market value today, and my child technically bought it for $1. So when they sell it, even if they sold it the very next day, they are taxed on that same amount of money. So you've just paid twice the amount of tax just because of poor planning. So let's look at how that works as an example. So we do want to sell it at a discount. So parents own the cottage. Let's say they paid $100,000. It's currently worth $300,000. I'm going to sell it to a child for $1 for sake of argument. So parents still have to pay tax based on the increase in value. So $100,000 to $300,000, what it's worth. $200,000 is the capital gain on that cottage sale or disposition. The child bought it for $1. So that's their new cost base. So if they sold it the next day again for $300,000, they are paying a capital gain of $299,999. So technically that same cottage, if it sold twice, had nearly $500,000 of capital gains on it, even though it's technically only worth $300,000. So certainly not very good planning, but definitely something you want to be aware of, because what you transfer it at for value or what you sell it to your child for value can make a huge difference, not just for your tax bill, but for their tax bill. And nobody wants to see their property being taxed far more than necessary. So certainly discuss that with the family, discuss that with your tax professional. Next one, selling it at fair market value. So obviously, quick, easy one. Hey, I want to sell my cottage to my child. I'm going to charge them exactly what it's worth on the open market today. Completely fine. That's great. You're going to have to pay tax based on fair market value anyways. So you're basically just treating it as you're selling it to Bob down the street for fair market value. So parents are taxed based on the actual capital gain. Children acquire it at the higher adjusted cost base, which helps them for down the road for their estate planning when they want to sell it, when they want to transition it to the next generation. Actual sale proceeds may or may not change hands depending on if parents want to actually collect the funds, but you are telling the CRA, you're telling people that they are paying you $300,000, so that is their new cost base. There are certain ways that it should be documented just to, again, keep it all legitimate and make sure everything's properly covered. Discuss that with your legal advisor, discuss that with your accountant to make sure it's properly documented. But of course, if you do sell it to them early on, let's say you sell it early in your retirement, but you still plan on using it for a couple of years, just note, as soon as you sell it, you are giving up control of the cottage and it is fully exposed to the creditors or the potential marital challenges for your child. You have zero say as to what's happening with that property going forward. They could sell it the next day on you and say, hey, I want the cash. I don't want to sit on the cottage. I don't want to pay all the maintenance fees. I want to use it every weekend, and mom and dad can't go and use it every weekend. Those are definitely factors, not necessarily saying your kids are going to do that to you, but certainly a consideration that you are giving up some of that control. So promissory note and capital gains reserve, these are two things that sometimes parents will factor in. So parents may choose not to receive any cash from their child or their children, and instead they want to complete an interest-free promissory note for the full purchase price. So even though I'm selling to, Susie, my daughter, for $300,000, I don't really want any money from her. I'm going to call it as a loan, and then that loan may be forgivable when I pass away. Maybe there's an interest charge on it. The debate as to whether it can technically be interest-free or it has to charge at least the prescribed rate set by CRA, definitely a conversation to have with your accountant or your lawyer. You want to make sure that the loan is properly documented. You can't just scribble it on a napkin or have something that you've just had as a verbal conversation. We want to make sure it's well documented, especially if that loan is used as a way to protect the asset from creditors or family property concerns. Periodic payments are certainly encouraged and may be required to prove that this is an actual legitimate loan agreement and not just a way to creditor proof this property transition. So again, make sure it is absolutely well documented to make sure that it is the old CYA.
Yeah, they're always good tips, the CYA.
Yes.
A related topic here, Adam, you just touched on the concept. The questions we were getting in the chat were a little more specific. It might just be terminology, but the question was, what if in my later years I sell to one of my children at close to fair market value? In this case, they take a deposit and then they hold a mortgage on the property, and upon death, they forgive that loan. So essentially a situation you just talked about, but they're using the term mortgage. Does that make a difference?
It's really the same thing, whether you call it a loan or a mortgage. A mortgage, technically, you are registering an interest against the title of the property. So you're going to say, bank of mom and dad has first priority when this gets paid out, which means that no other loan or mortgage, bank can go and register against that title unless mom and dad waive their mortgage first. Mortgage is basically just the way it's registered on the title to show kind of, again, the legitimacy of the process. And that can also be a great way to equalize the estate. Mom and dad say, oh yeah, it's $300,000, but we forgive it upon death. It comes out of your share of the inheritance. So that can also be used as a tool to kind of keep things fair when there's multiple children. So no, it's definitely can be a good way to do it.
Okay. And we're jumping around a little bit here, but one more that just came in here, Adam, not on this specific topic, but one you touched on a little earlier, and it has to do with the property. It says, if the property is in the parent's primary residence, would you be double taxed in that situation? So the parents are the ones on the property, it's their primary residence, and I imagine the situation here is to pass it on to the next generation. Would you still have that double taxation you had talked about earlier?
You shouldn't. I'm gonna put an asterisk beside that one. You shouldn't. It is a principal residence, and principal residence should be considered tax exempt under the current rules. So we never know if rules are going to change down the road. The one thing we would be, mindful of is it the children's primary residence when it does transition? So even though the parents qualify, the child may not qualify when ownership changes. And now there's a capital gain on it moving forward. So sometimes parents will say, I'm going to sell property to my child just so I can get the cash from them, or just to, again, avoid that whole probate thing. And parents are still going to continue to live there until they pass away. So the time from when they transfer to the time it's sold down the road is now subject to capital gains because it's maybe not the child's principal residence. So likely not a double taxation, but you're not fully utilizing the principal residence exemption.
Okay, perfect. And we appreciate the comments. Please keep throwing them in the comment section. We'll get to as many as we can. Thanks, Adam.
All right, thank you. All right, so carrying on with the promissory note, I think we did cover some of this, but this is now looking at the capital gains reserve. So parents may choose to spread the capital gains income over a period not exceeding 5 years. So a different example, let's say the total taxable gain is $250,000. So that would be an option to split that over 5 years. So now you're bringing in $50,000 of capital gain each year for a 5-year time period. So that can potentially help soften the blow of the large capital gain, which may push you into a higher tax bracket. The other thing you want to consider, so it's going to reduce the annual income tax burden and reduce the tax rate being paid. However, it can lead to the problem, especially if you're over 65, that your old age security might get pushed to clawback for not only 1 year, but all 5 of those years based on all the income that's coming in. Again, you're just spreading out the capital gain. Even though you may or may not get the cash on it, it might cause your old age security to get pushed into that clawback territory, or the recovery tax, as it's called as well. So something to check on and compare. And it might be worth just taking the tax hit in that one particular year versus spreading it out. Certainly chat with your financial planner, chat with your accountant just to run some scenarios and see what might be the most optimal for you. All right, so this is a fun one. I'm going to outsmart CRA, and I'm going to put my cottage inside the corporation. So CRA has thought of pretty much every scenario already, so it's not like we're likely going to outsmart them. They've pretty much thought of anything, and everybody's tried pretty much every way to get around paying the tax bill. So in this case, a corporation owns the cottage. This can lead to potential taxable disposition when you roll the cottage into the corporation. There's different ways that you can do that transition. Certainly chat about with your accountant to figure out what may be the most logical way to do it. So, a corporation doesn't die, the shareholder does, and the value of those shares, which, but for simple math, would be the value of the cottage. So you're still getting taxed on it when the shareholder passes away. You do have the option to do something called an estate freeze. That's a much bigger conversation. There is ways that you can do that, but again, you're not necessarily getting around the tax. You might actually have a whole new tax problem. So now when you're using a cottage every year, you're going to be taxed as a shareholder benefit based on maybe market rent. If I had to go and rent my cottage for a week for $2,000, well, now that's a taxable benefit every time I use the cottage, because that's what I could, in theory, rent it out on, and that's what the corporation needs to charge me for it. It can also lead to double taxation. So even though my shares are sold when I pass away and taxed, maybe the kids go and sell the cottage. Now the corporation is taxed when the cottage is sold, and I'm taxed again when I take the money out of the corporation. So it certainly can lead to some challenges. There is no principal residence exemption. A corporation is not an individual. An individual gets a principal residence exemption. A corporation does not. And of course, we have another tax filer, so there's ongoing accounting and legal costs for maintaining that corporation every year. All right, here's another one. What if I just transfer the cottage to a trust? So an Inter-Vivos Trust or Inter-Vivos Trust is a trust for the living. It could be a family trust, as often the term would be. Again, no principal residence exemption. A 21-year rule applies, which means every 21 years, whatever the trust owns is considered taxed at that point in time. So really that capital gains is being taxed roughly every 21 years. Again, you're changing ownership, so it's a transfer, it's a disposition for tax purposes. Depending on if it's titled land, you might even have land transfer tax because you're changing ownership. So the title has to change, which means you have to pay that fee again. You do have the option, though, to add beneficiaries to the trust. So maybe I want to add my children, my grandchildren, and they all have the ability to use this property. Lots of different trust terms that can be added on there. Maybe I say, hey, the trust gets this cottage, gets the cash. The trust is going to pay all the bills on it. And one day maybe it rolls out to, my son or my grandkids. A variety of different ways. It can be a great way to protect it from creditors as well. But of course, there is, maybe some less flexibility, less tax advantages. So different things to consider. Can be a good way of sharing arrangement, covering the maintenance costs, a lot of those different factors. So things to consider, have a chat with the accountant. But again, there's annual filing fees. The rules of trust are constantly changing, so different things to factor in there. Other options, I'm not going to go into them today. They're a bit more complicated. It would be something called an alter ego trust or a joint spousal trust. These are options after age 65 only. If all of a sudden you want to explore those further, certainly have a chat with us or chat with your legal or tax professional. Testamentary disposition. So testamentary is referring to upon death. So through the will is a testamentary disposition. Let's say it goes to multiple children. Kevin wants his cottage to go to 3 kids. So what happens if one of them wants to sell the cottage? I've told them that all 3 of them are stuck on the cottage together. Can one of them buy out the other one? Is there a shared ownership agreement as part of the condition in the will? Am I stipulating that, okay, they all get the property, but they have to make a shared ownership agreement so that they can plan out who's going to pay the bills, who's going to pay the expenses, who's going to pay for what improvements. Sometimes one child is maybe a handyman and the other one is absolutely not. Is it fair that the one individual is going to put in all the sweat equity, the other one's not really doing anything, so he's not technically doing his fair share? Is that going to keep the peace amongst the kids? Is the property transferring to the next generation joint with right of survivorship, tenants in common, so that each of the kids is splitting out their percentage? When one of them passes away, is their share going down to the grandkids, or is it just going to the survivor 2 kids? I do see that quite often. People don't know exactly how the title is registered. So if we're looking at the estate planning side, who's getting that cottage? Is it your sibling that you're joint with on the property, or is that actually get to go through your will? Creditor marital concerns, I've mentioned that a few times. Most definitely want to be realistic and want to be fair, trying to keep the peace for the next generation. I'm sure we all have the best of intentions and don't want to see our children fighting. We want to keep it as fair as possible, and we want to be realistic with, maybe Bobby and Susie can't get along well enough to actually share a cottage. So perhaps it's probably not a good idea to actually make them share the cottage. So certainly, again, have that family conversation. Oops, wrong one. Co-ownership consideration. So who has the right to use the cottage and when? Do you have to bid on the time to use the cottage? Can both families use it at the same time? Maybe there's the long weekends. Are they splitting long weekends? Maintenance expenses, sweat equity, I mentioned that. Renovation style and design agreements may seem silly, but if somebody wants to renovate the property, who gets to decide on the paint colors? Who gets to decide on the kitchen style? All those things. What happens in the event of a disagreement? What happens on a marriage breakdown? What happens if one of them becomes insolvent or bankrupt or has creditor problems? We want to protect the cottage. What happens when one owner dies? Should each one have insurance on the other to buy the other person out? All those are important considerations when it comes to sharing the family cottage. Kevin.
Yeah, basically, the question that I want to know about on this one is, you've mentioned a whole bunch of these different situations that may be going on. Now, as we mentioned beforehand with probate, I mean, there's usually different rules that apply in different provinces. Is that something that goes on? Do different jurisdictions have different rules in regard to how this is handled?
Every province does set their own legislation when it comes to for estates and for the testamentary side. Everybody does set their own rules. Most provinces are fairly similar when it comes to not necessarily the probate fees, but kind of the overall process and how the ownership structure works. The only province that is likely the most different potentially would be Quebec. Most of Canada falls under common law versus Quebec, which would be the civil code. So they do have a different set of legislation. So again, it depends which area your property happens to be in, but certainly chat with somebody who's familiar with that area.
Wonderful.
Okay, moving on. So again, life insurance can certainly be a great way to, maintain a fair estate. Keep the taxes paid on the cottage. Certainly a variety of options that exist. When it comes to it, there's a lot of solutions that are possible. Certainly want to chat with somebody like ourselves who can help navigate this and figure out what is the best solution for your particular situation. Most of the time, a tax bill in the cottage, especially if we're looking at long-term estate planning, equalization conversations, is not a temporary problem. So we're not looking to fill that gap with a term insurance. We're looking at a whole life, something that's going to be there for the long term, a permanent life insurance. We want that insurance policy to pay out when we're 90 some years old and pass away to our next generation. So different things we're often looking at are, these are some scenarios. We'll often look at participating whole life insurance that pays a dividend out onto the policy that's growing that policy value. You know, our tax bill is growing over time, so why don't we have a life insurance policy that's also growing in value so that we can try to keep up with that tax bill? If we just buy a flat 250,000 today, but our tax bill problem, you know, maybe 30 years from now is $500,000, well, that's no good. It's not going to grow enough to cover that tax problem. So perhaps we buy a policy that's going to grow along with that tax bill to match that future death benefit amount that we require. So how participating policies work is they're paying a dividend into the policy to help grow the value. These are considered tax exempt, so all that growth is tax free, so long as it pays out with the death benefit down the road. Most insurance companies in Canada have been paying the dividends between 100 to 150 years, have never missed a payment regardless of market conditions. So this gives an example that they're trying to smooth out the returns so you don't get the dramatic ups and down swings on the investment side, and they're just paying that amount to the policy going forward. So just a little bit of historical context, just showing a breakdown. You know, the green line, we see interest rates obviously have gone down and been low for quite a long time. Markets, they do naturally go up and down. And of course, the participating fund, the insurance policy, is paying a fairly steady rate of return at around that 6% mark over the last 8 years or so. Clinton.
Excellent. Yes, thank you, Adam. I know we're about to go through a couple examples of cottages, taxation, and a couple of strategies to help tackle that. But just as a point of clarification before we get into all the nitty-gritty details there, if someone had a secondary property, perhaps 2 homes or their own additional land, all these strategies would still apply in those cases. It's not just the cottage, correct?
That's a great point. So even though we're focused on cottage today, I mean, if you own multiple properties, you may own rental properties, you may own farmland, you may own just bushland, you might have development land, you might have vacation property somewhere else, a second home, even like a condo that I go and live at in Vancouver when I jet set and go visit people over there. It's not your principal residence, so a lot of these things can apply, and you'll have tax problems on a lot of those properties. So certainly a good thing to note that a lot of these strategies are not tying directly just to a cottage property.
Excellent. Thank you.
So again, let's look at some of these tax problems and how an insurance policy may be a good strategy to help mitigate that tax bill for down the road. So we're going to bring it back to Joe and Mary. We saw that family cottage. Current tax bill today about $100,000. We know roughly at age 90, it's probably going to be about $240,000. We do want to cover that as efficiently as possible. Not necessarily saying we're going to get around paying that $240,000, but hopefully we can help soften the blow a little bit when it comes to that tax bill. So again, what are some different ways that we can pay the tax bill? Obviously, we can pay it from other resources. So we can liquidate the asset or any assets to pay the tax bill. The kids can take out a mortgage to pay the tax bill. In all 3 of those scenarios, either way, the tax bill is being paid for that $240,000, and it's costing $240,000 out of somebody's pocket. The other way of looking at it is we can set up what's called a joint last to die whole life insurance policy. So in this case, we quoted a policy that's going to grow to be a value, again, growing, participating to $251,000 by age 90. So by coincidence, it happens to line up with the tax bill of $240,000. Annual payments, $5,400, and nobody loves seeing a big insurance premium. But in this case, it's an investment to pay less overall for the tax bill. So the actual cost over 25 years is to pay that same $240,000 tax bill, cost only $135,000. So to pay the $240,000 to the government, you've technically only forked out of pocket $135,000. So even though you've paid the same amount to the government, it's cost you over $100,000 less to pay the CRA that tax bill. And best of all, the kids aren't forced to sell the cottage. There's no additional financial burden for the kids, the next generation, the estate, to make sure that that cottage can stay in the family. And of course, they can continue to make memories for years to come, for generations to come, as that's what we want when we're looking at transitioning the cottage. Otherwise, we just sell it and have fun with the cash ourselves. We want those memories to continue on in the family.
Adam, a quick question on this. Do both I and my spouse need an insurance policy in this example?
So in this example, it's called a last to die policy. So both spouses would be insured on the one policy, and it pays out when the second person passes away. So both are insured. It pays out one time when the second person passes away. Generally, you get more bang for your insurance dollar when it comes to that, as the tax bill is only owed when the second person in the couple passes away anyways. So that's why we often structure these as a joint last to die. There may be scenarios where a first to die makes sense, or a single life policy. Again, it is different for every couple situation, so I don't want to say that fits every scenario. But again, good question. We do want to look at it on a case-by-case basis to find the right fit.
Thank you.
Excellent. Okay, so nearing the end here. Thanks for bearing with me. So planning for the family cottage. Again, some key things to remember. What happens if I have more than one child or more than one beneficiary who's going to inherit that cottage or get other amounts in the estate? One beneficiary, let's say they get $1 million cottage. What does the other beneficiary get? And most importantly, what is fair? And again, we go back, fair is not necessarily equal. But there can often be, family discord with unequal distributions. Again, the key is having those conversations with the family. We want to make sure everybody's on the same page. Everybody, agrees as to what's fair, and they understand your rationale, your thought process behind it. Even though, most people don't like having these conversations, they are extremely important conversations to have in the family. Is additional insurance needed to equalize the estate? That could very well be a good solution to help keep things fair. Child gets $1 million cottage, we get $1 million insurance policy, pays out, everybody's happy. Sometimes people will get the kids to pay for the insurance policy so that the cottage can transition to them without a tax bill. We just saw it saves them about $100,000 doing it that way. That might very well be a good fit. Are there enough other assets to pay the tax bill on the estate and, of course, leave an equal or fair distribution to your other beneficiaries? And of course, a plan for today, peace of mind tomorrow. You want to work with a good team, your investment advisor, financial planner, your accountant, your lawyer. We want to make sure that everybody's on the same page, having an open and honest discussion as to what your goals are, your objectives, what your financial situation looks like, any family dynamics. At the end of the day, we've pretty much heard it all. Have a conversation. Let's get on the same page. Let's map it out. Let's create that plan for you as to what it should look like, and make sure that we're covering any of those pitfalls and coming up with the right strategy to fit your financial situation, especially when it comes to cottage succession planning. And that is it for my presentation. We're going to end off with any questions.
Yeah, we covered lots throughout the presentation, and we tried to answer some by directly chatting in the comment section there. But if there are any other questions, let us know. We certainly can help out. So if there are a couple more, you can type them in, and we'll try to cover them before we go. But also a reminder, Kevin, you want to tell folks, chatwithclintonkevin.com?
Yeah, basically, if you have anything that you want to ask us now that we didn't answer here on cottage succession planning or other options in the financial planning field or investments, please feel free to get in touch with us at Chat with Clinton and Kevin. Visit our website at beckerrohr.com. You can watch some of the previous videos we've made and webinars that we've hosted on our YouTube channel. And also, if you want, you can like us on Facebook. That's always something that we really appreciate, and we're more than willing to help out with.
Absolutely. I know we're tight for time. We told folks an hour and a little over that, but we had one last question come in here. Adam, I think you mentioned it a little earlier, but I think it's appropriate. They're asking about property in the U.S. They specifically said mobile home, but I think the answer is regardless if it's a house, a mobile home, property in the U.S. is a whole other ball of wax, right?
Yeah, property in the U.S. is certainly another ball of wax, and my best answer it can be it's complicated, but generally your tax situation, at least for the capital gains on the Canadian side, you sell a property with an increase in value, you're going to have a tax problem. Further to that, there's a whole nother layer on the U.S. side, which we really don't have time to go down today. And it's definitely going to be on a case-by-case basis, and especially as the U.S. is constantly changing their estate laws, and especially with the new president, there are some changes that are kind of in the works there as well, which is going to change everything entirely.
Okay, well, I appreciate the time. Thank you for the answer, Adam. And we tried to get to as many questions as we could. I appreciate there's still a few in the chat we did not answer. And sometimes folks want to ask something that they're not comfortable throwing out in public. So if you have details of your situation specifically, we're happy to help out there as well. You can contact us offline, the chatwithclintonkevin.com. We're more than happy to help out. So simply let us know, and thank you everyone for tuning in. Take care.